Contribution margin versus EBITDA. Understanding both contribution margin and EBITDA, earnings before interest, taxes, depreciation, and amortization, is essential for assessing a company's financial performance and making informed business decisions. Let's explore each concept in detail. Contribution margin. Definition. Contribution margin represents the amount of revenue generated from sales that contributes to covering fixed costs and generating profit after accounting for variable costs. It reflects the portion of sales revenue available to cover fixed expenses and contribute to the company's bottom line. Mathematically, it is calculated as contribution margin equals sales revenue minus variable costs. Purpose and use. Profitability assessment. Contribution margin is a critical metric for assessing the profitability of products or services, particularly in cost-volume profit analysis. It helps financial analysts evaluate the impact of sales volume changes, pricing decisions, and cost structures on overall profitability. Cost-volume profit analysis. By analyzing contribution margins, financial managers can determine the break-even point, the level of sales at which total revenue equals total costs, and assess the company's profit potential at different sales volumes. Margin of safety. Contribution margin analysis helps quantify the margin of safety, the difference between actual sales and break-even sales, providing insights into the company's ability to absorb fluctuations in sales volume without incurring losses. Improvement and decline. Profitability improvement. Increasing the contribution margin can be achieved by enhancing pricing strategies, reducing variable costs through economies of scale or process efficiencies, and optimizing product mix to focus on high-margin offerings. Warning signs. A declining contribution margin may indicate deteriorating profitability due to factors such as pricing pressures, rising variable costs, or inefficient operations. Financial managers should promptly address these issues to prevent further erosion of profitability. Importance for financial management. Strategic decision-making. Contribution margin analysis guides strategic decision-making processes, such as product pricing, cost management, and resource allocation, by providing insights into the profitability of different business segments. Profit maximization. Maximizing contribution margins is essential for achieving overall profitability and shareholder value creation. Financial managers focus on optimizing revenue streams and controlling variable costs to maximize the company's contribution margin ratio. Investor confidence. Investors and financial analysts use contribution margin analysis to assess a company's financial performance, profitability drivers, and long-term sustainability. A strong contribution margin indicates efficient cost management and revenue generation capabilities, enhancing investor confidence and valuation. EBITDA. Earnings before interest, taxes, depreciation, and amortization. Definition. EBITDA. Earnings before interest, taxes, depreciation, and amortization, is a financial metric used to measure a company's operating profitability before accounting for non-operating expenses and accounting charges. It provides insights into the company's core operating performance and cash flow generation capabilities, excluding the impact of financing decisions, tax policies, and non-cash expenses. Mathematically, it is calculated as EBITDA equals operating revenue minus operating expenses excluding interest, taxes, depreciation, and amortization. Purpose and use. Operating performance evaluation. EBITDA is a key metric for evaluating a company's operational efficiency, profitability, and cash flow generation capabilities. Financial analysts use it to assess the company's ability to generate operating income from its core business activities. Financial modeling and valuation. EBITDA is commonly used in financial modeling, business valuation, and investment analysis to estimate a company's intrinsic value, assess its financial health, and compare profitability across companies or industries. Debt service capacity. Lenders and creditors use EBITDA as a proxy for a company's debt service capacity, as it provides a measure of the company's ability to generate cash flow from operations to meet debt obligations and interest payments. Improvement and decline. Operational efficiency. Increasing EBITDA can be achieved through operational improvements, revenue growth initiatives, cost reduction strategies, and enhanced asset utilization. Financial managers focus on optimizing operating efficiency and maximizing revenue streams to improve EBITDA margins. Warning signs. A declining EBITDA may signal operational challenges, declining profitability, or cash flow constraints. Financial managers should identify the underlying causes, such as declining sales, rising expenses, or inefficiencies, and implement corrective actions to restore profitability and cash flow generation. Importance for financial management. Cash flow assessment. EBITDA provides insights into a company's cash flow generation capabilities from its core operations, excluding the impact of non-operating factors such as interest expenses, taxes, and non-cash charges. Financial managers use it to assess the company's ability to service debt, fund capital expenditures, and support growth initiatives. Business valuation. EBITDA serves as a key metric in business valuation models, such as the EBITDA multiple or enterprise value (EBITDA ratio), used to estimate a company's enterprise value relative to its operating profitability. Financial managers use EBITDA multiples to compare valuation metrics across companies or industries and inform investment decisions. Performance benchmarking. EBITDA analysis allows financial managers to benchmark a company's operating performance against industry peers or historical performance metrics. Identify areas of strength or weakness, and develop strategies to improve profitability and competitive positioning. Conclusion. Contribution margin and EBITDA are essential financial metrics used by financial managers, analysts, and investors to assess a company's profitability, operational efficiency, and cash flow generation capabilities. While contribution margin focuses on product-level profitability and cost-volume profit analysis, EBITDA provides a broader view of a company's operating performance and cash flow dynamics. By analyzing these metrics, financial managers can make informed decisions, optimize profitability, and drive sustainable long-term growth. Useful expressions. Our contribution margin analysis indicates that product A is our most profitable offering. To improve profitability, we need to focus on increasing our contribution margin through cost reduction initiatives. The contribution margin ratio for the new product line is higher than anticipated, which bodes well for our bottom line. We need to calculate the contribution margin for each product to determine their profitability. Let's review the contribution margin for each business segment to identify areas for improvement. The contribution margin analysis revealed that certain products are operating below their break-even point. To maintain profitability, we must ensure that our contribution margin exceeds our fixed costs. Our marketing campaign resulted in an increase in sales revenue, but we need to assess its impact on contribution margin. The contribution margin analysis will help us make informed decisions about product pricing and resource allocation. Our EBITDA margin has improved significantly over the past quarter, indicating strong operational performance. Investors often use EBITDA multiples to gauge the valuation of our company relative to our peers. The EBITDA analysis suggests that we need to focus on controlling operating expenses to boost profitability. We need to calculate EBITDA to assess our ability to service debt and fund future growth initiatives. To attract investors, we must demonstrate a consistent track record of positive EBITDA. Our EBITDA growth reflects the success of our cost optimization efforts and revenue growth strategies. The EBITDA calculation excludes non-operating expenses such as interest and taxes, providing a clearer picture of our operating performance. Our debt covenants require us to maintain a minimum level of EBITDA to ensure financial stability. The management team uses EBITDA as a key performance indicator to evaluate business performance and guide strategic decisions. Let's analyze the drivers of EBITDA growth to identify opportunities for further operational improvements. Understanding the contribution margin of each product line helps us prioritize our marketing efforts. Our goal is to increase our contribution margin by renegotiating supplier contracts for better pricing. We conducted a thorough analysis of our contribution margin to identify opportunities for cost savings. The contribution margin analysis revealed that product B has a higher profit margin despite lower sales volume. To improve our overall profitability, we need to focus on increasing our contribution margin ratio. Let's review the contribution margin trends over the past few quarters to identify any patterns or anomalies. By reducing variable costs, we can enhance our contribution margin without sacrificing product quality. The contribution margin analysis showed that certain product variations are more profitable than others. Our pricing strategy should aim to maximize contribution margin while remaining competitive in the market. EBITDA is a key metric used by investors to assess our company's operational performance and financial health. We need to calculate EBITDA to evaluate the impact of recent acquisitions on our overall profitability. Improving our EBITDA margin requires a focus on increasing revenue and controlling operating expenses. Our EBITDA growth reflects the success of our strategic initiatives to expand market share and improve operational efficiency. To attract investors, we need to demonstrate a strong EBITDA track record and future growth potential. The Board of Directors uses EBITDA as a primary metric for evaluating executive performance and compensation. By analyzing EBITDA by business segment, we can identify areas of strength and opportunities for improvement.